Malaysia's daily new COVID-19 cases topped the 7,000 mark for the first time today, with 7,289 infections, as Selangor continued to lead all the states and FTs in infection numbers. Selangor recorded 2,642 new cases. The country's previous record high number was 6,976 new cases on Sunday, according to Health DG Tan Sri Dr. Noor Hisham Abdullah. Recoveries today numbered 3,789, while the number of new deaths amounted to 60. On his official Twitter, Noor Hisham warned the public to prepare for the worst in facing the current COVID-19 wave, following an exponential trend indicated by the COVID-19 graph. He says the rise in cases started on April 1st and could trigger a vertical surge, and continued to urge the public to stay home to break the chain. Today was the start of stricter SOPs across the country, such as requiring more people to work from home, curbing unnecessary movement, and shortening business hours. This measure was done in lieu of a full lockdown to preserve the economy, which is still struggling to cope with the devastating ripples from the pandemic. GENTING Malaysia continued to bleed in the first quarter as its net loss widened to 483.6 million, compared with the 418 million net loss reported in the first quarter of FY20. Revenue tumbled 68% to 623.4 million. It is worth noting that the group has been loss-making for 6 consecutive months. This was squarely down to the temporary closure of the group's businesses in Malaysia and the UK and various movement curbs, resulting in capacity controls. The only saving grace has been the group's move to control costs as it managed payroll and headcount. GENTING Malaysia maintains its cautious stance on its near-term prospects as recovery setbacks persist, as travel restrictions remain in place, and as such will continue to align its cost base to the challenging environment. The imposition of MCO 3.0 will continue to adversely affect the group's business following the temporary closure of its casino operations from May 24th. Overseas, GENTING Malaysia says it will continue to focus on driving revenues for its operations in the UK and reaffirms its commitment to reinforcing its position in the US. It was a similar earnings story for PETRONAS' listed companies, PETRONAS Gas and PETRONAS Dagangan. PETGAS saw its first quarter net profit jump 40% to 516.4 million, despite a drop in revenue for the quarter, helped by lower operating costs and favourable forex. Revenue fell by 4.5% to 1.35 billion as income from its utilities segment dropped in line with lower product prices. PETGAS still declared a dividend of 16 cents per share. PETDAG returned to the black for the first quarter, registering a net profit of 191.1 million compared with a net loss of 29.4 million last year. This was due to higher gross profit recorded and lower operating expenditure. Revenue for the first quarter dropped 22% to 5.1 billion. PETDAG declared an interim dividend of 14 cents per share. PETGAS is expecting its performance for the rest of the year to remain resilient despite the ongoing pandemic, as its business model and long-term contracts ensure steady revenue streams. PETDAG's outlook is more tempered as its retail business continues to be affected by the pandemic. Hence, it will continue to concentrate on digital solutions, which are pivotal during these times. Sime Darby saw its third quarter FY21 net profit more than double to 300 million, driven by the strong performance of its automotive division. Revenue improved by 31% to 11.02 billion from 8.43 billion for the quarter. Sime Darby declared no dividend for the quarter. Its car dealership business showed solid growth, recording an increase of profit of 143% to 250 million, mainly due to the strong performance of the Greater China region. Group CEO Datuk Jeffrey Salim Davidson says its motor division performed well on the back of sustained strong demand for luxury cars, as restrictions on international travel meant that more was spent on luxury products. Looking ahead, Sime Darby says that while many economies are expecting stronger growth, significant uncertainties remain given the unevenness of the global recovery. However, the group is cautiously optimistic that it will register a strong set of results for the fourth quarter of FY21. Other factors to keep an eye on include the ongoing tension between China and Australia and supply shortfalls in some new car models due to semiconductor shortages. AFFIN Bank's net profit for the first quarter fell 44% to 68.94 million, largely because of lower net gain on sales of financial instruments. Not helping numbers were higher other operating costs. Revenue declined 14% to 537.6 million. While cost rationalisation helped with operating expenses, cost-to-income ratio increased to 63% from 52% in the first quarter due to lower revenue from capital markets. The weaker result came despite an 11% increase in net interest income, a 7.7% increase in Islamic banking income, a higher net fee and commission income, and lower allowances for impairment losses and lower taxation. AFFIN attributes the improvement to the better net interest margin, backed by higher overall CASA composition and reduction of cost of funds. President and CEO Datuk Wan Razli Abdullah Wan Ali says the group is mindful of the ongoing downside risks, hence it will continue with prudent risk management practices and cost containment measures.